Hey guys, we'll get started now. Want to say thank you for the opportunity to talk today. And for those who are new, we do this every Thursday at 4 o'clock Central. And the idea is to allow you guys the chance to know, grow, learn different ways to sell, talk about different opportunities. Every once in a while, we'll have carriers on as well to do this because I'm sure the monotone magic doesn't work all the time. So, got to get some flavor in here. But the big thing is that if you have questions right now, they'll all go into the Q&A chat box. I will answer them as we go along or at the end, time permitting. The big thing is that I will be transitioning this over to a not Google, Zoom meetings come July 1st. So trainings after that will be in a meetings format so people can talk. We can all learn, know, and grow from that standpoint as well. If you're afraid of that, change your name. So, real quick, some quick reminders as always. The great collaboration, www.tgcconference.com. Please feel free to register nowish. And if you're booking a room, do it by tomorrowish because that's when the rates go up. I'm working on getting an extension because I've had a bunch of people say they want to do it, but they're just procrastinating. So we're gonna just try and see if we can get an extension for some peeps. But nonetheless, don't wait. Just register now. If you get a book, if you can book a room as well, that would be in an email that you'll get after. So the big thing here, it's all about collaboration, different opportunities that are going to be said at this meeting, alternative real estate investment strategies, ACA Medicare, group life, group health, life insurance, different ways to sell life insurance, annuities. We'll talk about the power of zero with David McKnight. So just a great event. Once again, www.tgcconference.com. It is a month away, so I'm looking forward to this. If you have missed prior trainings in the past, look for at Valor Financial on YouTube. I have under the videos tab all the old trainings that I've done. So we have an opportunity to get caught up. You can binge watch if you will. Or if you need some nighttime listening, then I'm sure I can help you out with that too. So, got about 38 videos, all the different things that we have to offer, strategic partnerships, carriers, and things like that. It's also in the newsletter. So, every time I send out the newsletter, I have a link to this so you can subscribe and never miss out. So, today, what we're going to talk about is understanding annuities. Okay. It's very important because when we think about it, we want to think about some of the retirement concerns that a lot of people have. So when you think about that, studies show 64% of people are more concerned about outliving their money than they are even passing away. So we have a big problem on our hands. A lot of people nowadays are starting to live longer, and that's a major problem because we haven't even thought about that. Most people, after they retired, the idea of a pension made sense because most people didn't live much past like 5 to 7, maybe 10 years past retirement age. Now we got people living into their 80s, 90s, some even hundreds. So there's a big concern is what's going to happen to my assets. We have investment fluctuation. How often do we see the stock market fluctuate and has ruined a portfolio? Now, I'm 42, and about 2 years ago, when I finally broke free and independent, I had a 401k at my prior company. Unfortunately, that prior 401k turned into a 201k because there was a giant drop, about 40% in January of 2022. So can you imagine if I wasn't 40 at the time and I was closer to 65? When we talk about that retirement red zone, you think 5 years before you retire and 5 years after is probably the most critical time where you want to start taking less risk. How long does it take to recoup those losses? Does your client really have time to make up those losses? So that comes to a point of asking the right questions for your client. Wouldn't it make sense to, do you think that this is going to be appropriate for long term? Questions like that to get their mind thinking about alternative opportunities, which then you can present. The other thing, lower returns. Returns are never guaranteed in the stock market. As we all know, it can fluctuate. How can we provide our clients with the retirement they deserve with some guarantees? So there's been studies shown, I don't have the stats in front of me, but basically the thought process is I think it's around 70% felt more comfortable in their retirement when they had an annuity as part of that retirement portfolio for the guarantees and the comfortability. Unexpected costs. So healthcare is rising. You know, average 65-year-old couple needs about 300K in protection against healthcare, and 38% of adults 65 plus still have a mortgage. So, you know, what happens if you need a new roof, you got a new car, or need a new car? How can you afford these costs? You have to think about this type of planning in order to get to that retirement phase in life, so to speak. And, you know, people in their 40s have to start thinking about their 60s and beyond for retirement now versus waiting. Now, if we look at a couple slides here, this could be a little busy. So we'll look on the left-hand side. We talk about volatility. Are you overexposed? So, you know, my first job in the financial services industry, I work with a lot of financial advisors. And you talk about, like, I got FINRA registered, you talk about having a balanced portfolio. The whole idea of a balanced portfolio with a financial advisor is stocks and bonds. Bonds are very conservative, they're steady Eddie. Stocks are very aggressive. So as you get older, your aggressive should reduce as your conservative increases because you're looking towards that distribution phase versus accumulation phase. But if you'll notice here, the percentage of loss, 10% percentage of loss, 15, 20, you go down the pyramid there all the way to 50. When it comes to actually breaking even on this side, it's actually much larger. Um, can people see my screen? I see someone saying, oh, it's just the person. So thanks, Juan. But anyway, so when you talk about the break even point, so I'll take for example's sake my 40%. I now need 66.7% to recoup that loss. So it's not an even plus 10, down 10, plus 10, down 10, you're neutral. You're actually losing money because in order to get back to neutral, you have to work twice as hard. So if your portfolio took a 50% drop, well, guess what? Now you have to have 100% growth to get back to net neutral. And so what we see is a lot of people start to put, for example's sake, money into more conservative rates of return. So we look at, say, a CD. Now, a CD, for example's sake, is not going to beat inflation. You think about the taxes you're going to pay on the gains, you think about the inflation costs, and then you talk about the real returns. There isn't really a solid return when it comes to CDs. So, you know, the thought or the agenda of what we're looking at today really is what type of annuities can we really talk about with our consumers? You know, we want to talk about different types that can help them or different phases. So investment protection annuities, accumulation products, or sorry, investment protection, accumulation type products, and income products. So how can we protect our clients' investment with fixed index annuities? We have two different types that we're going to talk about today. All of these are based on the index annuities. We're not talking about MYGAs. MYGAs stand for multi-year guaranteed annuities. We're looking solely at the fixed index annuities. And so when we look at different ways to grow, we talk about the power of indexing. We talk about you can do fixed. So I already talked about that with a MYGA. A MYGA is basically like an insurance version of a CD. So it's a fixed return. It's very steady Eddie for 2 all the way up to 5, maybe even I think 10 years. I'll tell you here in just a sec. Yep, 10 years. So when you think about that, you're just looking for a percentage, a fixed percentage. It's kind of like the turtle versus the hare. Slow and steady wins the race. But then you also have variables. So once again, thinking about that portfolio of what we talk about with financial advisors, it's a mixture of fixed and variable, stocks and bonds, something like that. I know bonds are not fixed, but the idea is that the returns are not high comparatively to, say, for example's sake, the stock market. The downside is do we really want to be in it when you have that variable side? Everyone loves the uptick. Don't get me wrong. No one likes the downtick, but that is cyclical. Matter of fact, it's supposed to happen every 3 years. We just had a giant, what I would say, a bull run for a long period of time, and not a lot of people remember. I guess we're just short-sighted, but not a lot of people remember, having those cyclical downturns in the market to accommodate for these major rushes up. But then we've had 2 bad years, so 21, 22. It even bled into 23, but towards the latter part of 23, and now here we're seeing a better tick up. However, let's think about the third option, indexing. So with indexing, it offers you a best of both worlds. For example's sake, you have some upside market potential but no downside risk. So if I've heard it said this way, I'm not a fan of it, but people are like, so if you had a magic wand and you could pull your money out at the exact moment where the money went down and left it there and then put it back in, that's not entirely true. So if you use that phraseology, please stop. The idea is with the indexing, it does protect your money more than just throwing it all in the market. You do not participate in all the gains. Now take a look at this. This is the power of indexing. You have an index strategy versus the market. Now you'll see ups and downs in the beginning. You get mad by year 3 or data point 3, where you have $151,000, but your index is only $124,000. The index will stay neutral, as you can see, those 3 years, because there was a downturn in the market, 3 bad years, and then it goes up, then another big down, and then up, down. So as you can see, there's a benefit to the indexing. But I will be the first to tell you that you should not put all your eggs in one basket. Okay. If you can only sell annuities for a retirement plan, which is not the case with us here. But if all you think you can do is sell annuities, you have to understand that someone needs a variable side to it too. Too many people will say, well, all you need to do is throw all your money into an annuity. An annuity should be visualized from the standpoint of, I call it an aggressive bond. Now, even the bonds here are showing a little bit more aggressive than the fixed annuities. However, I would disagree with that because you have market type returns. So it's kind of like in the middle. You have fixed annuities and CDs are about the same. Money markets, accounts, I would also not say, okay, so it's a little bit riskier as they're putting it here. Money markets are very risk averse, CDs are risk averse. The fixed index annuities, I would say they're probably on the same level as the bonds, but this gives a good example as to how you can equate them. You should never say that they can beat out stocks. That's not going to happen. But if you talk about a conservative approach, this is your winner. This is like an aggressive conservative. I'll give you a good example. So I myself, when I retired from corporate life, I'll say, or I left corporate life and I built Valor, the objective and the goal was to focus solely on my business. Now I have this old 401k, and if I left it there, FYI, if you're hearing the words I'm using here, 401ks have a lot of fees attached to them. And if you're separated from service, you now have the ability to reposition those assets to something with less fees and different opportunities. I did not want to manage a variable account. I could have easily put this money into my IRA that I have at Merrill Lynch and just try to manage it. Well, I didn't want to do that. I wanted to say for sure that I'm not going to lose this principal, let it grow without me thinking about it, and get to my retirement. And that is one bucket to help me get to retirement. I will have my traditional IRA account where I will invest, $6,000, $7,000 a year and try and have that beat out market performance. So that's another bucket for retirement. As we talked about last week, tax diversification. The idea is to have multiple income streams to have that retirement that you're looking for rather than the one the government's going to give you. And so when we think about the first step in the annuity process, we think about the idea of the accumulation annuities. Now, accumulation annuities is solely focused on growth of funds to maximize the returns. You'll find that you've probably, if you've been in the industry a while, have sold annuities in the last few years. Now, keep in mind, the interest rates have gone up incredibly high over the last couple years. Now, that's bad for the housing market, people looking to get, lower loan rates on their houses. It is fantastic for the insurance industry. So people are even replacing annuities that were sold, say, 3 years ago because the cap on it is 1.5%. But now you're seeing with some of these newer accumulation annuities, you're offering, as you can see on the right-hand side, higher participation and higher cap rates. So 200%, 230%, those are with charges. Or on the other side, 145%, 170. So yes, I understand this is the first year. However, we have not seen strategies like this in a very long time. On top, you'll see some carriers even offer bonuses. This is the Athene product. I'm not saying use Athene, I'm just saying for example's sake. Some carriers offer bonuses, some do not. But the idea here, once again, is for accumulation. So I would say anyone below the age of about 55, this would be in the conversation. Okay. Now, why? Because if you think about the longest annuities, they're like 10 to 14 years. And if I'm in my 40s, say I'm 40 and I took out a 10-year, then come 10 years from now, I can find maybe a new annuity with something different. For example's sake, something that has a income benefit rider, which we'll talk about next. So this is more designed for higher accumulation. You usually have higher participation in cap rates as opposed to the income annuities. It has the downside protection. As I already mentioned, there's some premium bonuses that you can get. And then name brand investment companies. So you talk about NASDAQ here, the S&P 500, the A&P or AI Power Global. I think that's part of Watson from IBM, UBS. So you've got different opportunities here from a growth standpoint. If someone asks a great question, what's on average your client's earning interest? I would say you don't want to go higher than, say, 6 to 8% average. Again, long term, not every single year. So that way you're not putting your foot in your mouth because people will see charts, they'll see illustrations, and they'll say to themselves, okay, well, someone is giving me 200% and they're using a look back. So, say 10 years ago, well, 10 years ago, 8 out of the 10 were fantastic. And so then they take that and chunk it up 10, 10, and 10. And so you have 8, 16, 24 out of 30 years that are all crushing it with higher participation rates. So your illustration looks amazing. But, illustrations to me prove one thing, and that's ink sticks to paper. So you have to want to sell based upon the index strategies and why you like them, the meaning behind it, what the client is looking for. Again, the big reason would probably be that downside protection. Maybe they got burned pretty hard from the market, and this just gives them a better story from that standpoint to protect and preserve their assets. Then we look at the next phase, which would be the income annuities. So this is on the flip side. You are looking to maximize your guaranteed income for the client. Now, the idea here is, well, what if we do that on the other side? We're looking to maximize accumulation, not guaranteed income. So there is a difference. The accumulation is growth in cash value. The guaranteed income is not necessarily the growth in cash value. They have riders that give you guaranteed income for life that allow your client to pull out money systematically until they die. Now, that would be the olden days where a lot of people would do what's called an annuitization, which you can do with any annuity. Okay, you can annuitize the annuity and you get guaranteed income for the rest of your life. You can even get it with a 10-year period certain, or just the rest of your life. The downside with that is you lose control. So the idea of an income annuity means you still have control. You base it off of whatever the factor is, say it's 6%, 8% per year, depending on your age when you start the guaranteed income, but you could turn it on and off. That's a difference versus an annuitization. You have more flexibility with these income annuities. So you have potential premium bonuses. For example's sake, this is AIG. They're guaranteeing your income will rise by at least 10% every year for 25 years and protect it for life. That's this example. AIG will give you a 10% credit to your income benefit base. So if I had 100,000, next year I'll have 110,000, 120, 130. So they credit 10% simple interest until you start taking out the monies. Other carriers will have different things. I'm just using this as an example. So that's not increasing your cash value, it's increasing your income value. So it's kind of like one of my old friends on the annuity side at AIG would call it monopoly money. It's not the money you can pull out and take with you if you surrender the contract. It's the money that grows to allow you to have guaranteed income for the rest of your life. And so this is where you start to think about clients, maybe 50s. So there's a little bit of a crossover from the accumulation ones, but 55 to 65 to 70, you're looking more in this world because people are looking for guarantees. Once again, that's security for their entire life. You can even do it for a joint income, so you can have it on husband, wife, or spouses, whatever. And so you just have that opportunity too. So those are the two ways that you can really look at the annuity standpoint. The benefits really for the customer: protection of principal, growth without loss. You can have income that's guaranteed. You got relief of knowing that of what your retirement looks like. So if someone has the basic assets like mortgage still, electric, heat, whatever, they can cover those with an annuity and then have another line in stocks. Maybe they're like trading stocks personally, or they have a financial advisor or whatever. You have that other money for the vacation fund, for, other things. And then predictable outcomes. There's something to be said about having guarantees and knowing exactly what you're going to get. So from the producer standpoint, you give them more peace of mind, that ability to help them retire more comfortably. Turnkey product that can be replicated. So when you talk about turnkey products, that I butchered it, I guess I should have said products that can be replicated. You have the ability to sell one person multiple annuities. You have the ability to sell them one. We have one carrier that can actually provide income at one time and then add another and then another. And then instant compensation for you as a producer. You don't have to deal with underwriting. So they get placed, you get paid. If it's straight up cash, you get paid like the next week. You submit an application, goes through suitability, and then you'll get paid. So, and some could say it's an easier conversation as people really want to talk about retirement. One of our top agents at Valor, he leads off with annuities because there's a lot of opportunity from that standpoint. So really what we want to think about is, kind of what to look for when you're looking for annuities. A client who left a job and they have an old 401k, that's a great one. So clients who are retiring from their job and looking for security and safety, once again, we get to that retirement red zone 5 years before, 5 years into. That's where people get in the most danger. So they're either still investing heavily 5 years before retirement, and then the stock market takes a tanker. It's a big problem. Or 5 years after, they're going out to eat. They don't feel like staying at home and cooking because they're retired now. They join that golf club they always wanted to, even though they don't know how to golf, and they start taking on extra expenditures that they don't need. So we have to help people protect them from themselves. Also understanding that, another agent of mine who showed an article, and it's very true, the gray wave is coming. There's going to be about $30 trillion of assets passing from the silent generation and the baby boomers down to the Gen Xers and the millennials. And they're going to need help, a lot of it. So we got to buck the trend of people who are living in the now. How many times have you seen, commercials where they talk about, we don't know what tomorrow brings, so live in the now, go visit Panama or something like that. The problem is that if too many people live in the now, they're going to be working until they're 99. That's why all those old, I think, E-Trade commercials made me laugh when they were showing like DJ Nana and like this old guy running down the beach, like Baywatch kind of thing, just awful. So when you think about stuff like that, we want to make sure that we're protecting people, from their retirement. Clients looking to diversify their strategy, so maybe they lost a large chunk in the market and they don't want to play with the other chunk. And 401ks, Roth IRAs, those are all opportunities, even liquid cash. So if you have someone who wants to put a big portfolio in, we have someone who's doing what's called an annuity funded life, where they're going to put in, say, $2 million into an annuity and then take income withdrawals. And then from that standpoint, they're going to pull out the money and pay for a life insurance policy. Annuities are great to have while alive, but they're not a great asset to have at death. So that's why we have to understand that there's a boundary between both of them and when to use them. So what I would say is, really from this standpoint, it's time to take action. What I would say is, if you could think about it, write down 4 clients that have left a job recently or have idle money sitting around that they don't know where to invest. So it's time to make some phone calls from that standpoint and really start pounding the pavement. These presentations are great because it gives you some information. It'll help you be more in depth and knowledgeable. But if you just listen to it and leave it where it is, it's like putting a light under a cover. No one can see it because it's under the cover. So you have to take action. You got to let people know what you do. And when you can do that, then your actions turn into opportunity, turns into profitability for you and benefit for the client as well. So that's ultimately what we have to understand, is why we do this. It's for the benefit of the client. So what I'll do now is I'm going to show you off the 3Mark portal where you can get some annuity information. So practicality, yeah, you can always come to me. I'll gladly help you out. But if I teach you how to fish, you'll eat forever, right? So in this, what we do is, so we log into 3mark.com and we go to products and solutions and we click on annuities. First and foremost, you want some free labor. You got Bo Bluen here, who is an incredible asset. He works on annuities all day, every day. That's his deal. Okay. With that, we talked about MIGAs slightly. So multi-year guaranteed annuities, that's right here. So you can see what the current MIGA rates are just by going to 3mark.com. So once again, as I showed you in that other part of the presentation about the inflation part, even at 5.25, you're still, after taxes, you're not really beating inflation. So let's say, for example's sake, you want to get appointed with a carrier. You've already gone into online contracting and you got appointed with that carrier. Then the next step is going to the training guide here under resources and quotes and click on training guide. The annuity training guide gives you the exact spot where you need to go to get your training done for the respective carrier. And it gives you all the things you need to do in advance. Okay, so anytime you sell an annuity, you need to be appointed with the carrier and you need to finish the product training. Otherwise, it will come back NIGO, not in good order. And you have to go back and redate the app, and the client gets mad and all the other stuff. So you have all the training guides right in here and where to go. Firelight is where you'll submit the business. You can submit it online, one stop, one shop. You don't have to go to North American site, AIG's site, American Equity site. You can do it all in Firelight. And then resources and quotes back here, the annuity rate watch is good as gold. So if we click here to continue, this is a subscription that 3Mark has basically utilized for your benefit. And if you want to, I'm going to skip past MIGAs. I'm going to skip past fix. Let's talk about fix index. And I want to click on the product list. So we go to the product list and it has all your heart's desires on what to look for. So let's say, for example's sake, I have someone in good old Texas, let's say 100,000, non-qualified. So that's cash, that's liquid cash. And I am age 55. So I personally care about the ratings, but for this example, I'm not going to show it. And for a lot of you who get those emails and phone calls that say, "Hey, I got a carrier giving like 10% on a 5-year MIGA, call me." Those are like F-rated carriers, okay? Understand that if you want to make sure you don't have to have a bad conversation with the client later about what happened to their insurance company, stick with A-rated carriers, maybe B plus, but you don't want to go too far past that because yes, there's a higher, rating or opportunity, but what happens if they get bought out, bankruptcy, all the other stuff? You don't want to go down that road. So let's say, for example's sake, we want to see, product fees, yes or no. That would be those bonuses or higher buy-ups, if you will, for participation or cap rates. I'm going to go surrender charge years, let's say 10 years, and any riders. So if I want a guaranteed lifetime withdrawal benefit rider, I can do that too. I guess I didn't because I had an itchy trigger finger, but it'll pull up all these products and opportunities. So AIG is the first, Power 10 Protector. Why? Because they're showing the point to point on the S&P 500. AIG has a very high S&P 500. I am more of an S&P 500 fan today than I am the proprietary indexes because there's track record with the S&P 500. So if you're going to do a product mix, make sure you have some S&P in there. It gives you your free withdrawals, years 1, 2, and beyond, surrender charge years, any riders that are available. And you'll see Equitrust comes in here. They're a B-rated carrier. I only use them for one spot, and they're one of the only carriers, if not the only carrier, that allows an inherited IRA to have an income rider, which is extremely unique because if you get an inherited IRA, you're supposed to liquidate it within 10 years if you're not the spouse. So that's the only time where I'd really think of Equitrust if you want that benefit rider. But you could use this as a benchmark or a starting point. As you can see, a lot of great options and carriers. Let's take it to the next level and we talk about actual illustrations. So if I do new illustration, say good old Phil Resch, 55-year-old, 100,000 non-qualified, continue. Now, I could look for an income-based product or I could look for a accumulation product. So American Equity, this is an accumulation product. If you don't know which product to look for, that's why I say you do this fixed index part first, okay? But Asset Shield, I'm going to use them, so I'll hit add product. Now they're going to take my 100,000, allocate it to everything. So I usually just kind of uncheck these. If I'm doing something like with an annuity, I'll usually do like a 25% mix between carriers, between products. But golly, so many indexes. So let's say, for example's sake, I want to do the 1-year point to point for Bank of America. I want to do the not the monthly, the aristocrats. Let's do a 1-year for that. And for the sake of time, I'll just do a 1-year UBS. So you can update changes and it'll split it for you 33%. So that way you don't have to do it yourself. Or I'll add the SG Global sentiment, and now we got 25% apiece. Okay, so let's say I want to compare two carriers. So I go back over here, and let's say, for example's sake, I want to add in, I don't know, let's go with a theme. And with that, we want to use the Performance Elite 10. I'm not going to do the one with the bonus, because the bonus and the fee. This one does have a bonus, but I'll hit add product here. And once again, sweet mother of God, so many different index options. Now you'll see there's 1 year, and you'll see that there's 2 year, and then you'll see them with fees and without fees. So once again, the 1 year is, your client's going to get a return every single year. When I did my annuity, I knew last year wasn't going to be good either, but this year should be fantastic. So I did a 2 year point to point because I'm waiting for the bigger return with the higher participation rates as well. So let's just say, for example's sake, though, we're going to stick with the 1 years. So AI Power Global, S&P 500, UBS, and then we'll go with go NASDAQ. So update changes, and we could add a third one, but we're not going to today due to the sake of time. So we're going to hit continue. No flexible premiums, but to answer someone's question, you can do Roths and you can do it on a yearly basis. It will be an index. You can do that with American Equities Asset Shield. So that is one carrier you can do that with. This presentation will be available for viewing on YouTube as well, just because I saw that it's an easy question to answer. The bonus is paid up front for Athene. So man, I'm just nailing some of these out. Hit continue here. And then I'm going to hit continue again. And we're going to run the illustration and we're going to see how they compare. So it'll take a hot second. And what you'll see is a PDF will show up. Move my own face. I don't know if you guys see me moving my video, but now we got the PDF here. So your report created will pop up and you can compare them very quickly. As you can see here, based on illustrations, come 10 years, Athene should technically win based on the index strategies. Now, Athene, as someone did ask, is the bonus right up front? As you can see here, the bonus is right up front. And they're analyzing based on total returns. As you can see, the annualized returns are here. But once again, like I say, illustrations prove ink sticks to paper. This is just a quick way to get some analysis and see what big differences or little difference or whatever. Also, keep in mind the index strategies can also play into a factor of how these will come out. But it gives you comparisons, it gives you the guaranteed side, it gives you the non-guaranteed side, as if you were running it on the actual software with the carrier, but it's all here. So you talk about lowest years, current years, and highest years, between the carriers. So just a lot of different variation that you can use with this if you want to do like a spreadsheet kind of scenario for your client, as opposed to running 3 illustrations from 3 different carriers. So once again, just the idea here is to help your client make an educated decision at a quicker clip. And this is all PDF, so you can save this. Got all the stuff on the back end, some bells and whistles like nursing home waivers, stuff like that. And then the other carriers, I'll have both carriers. So I would highly recommend tinkering around with this. Once again, going in through products and solutions, annuities. Click to continue under resources and quotes, brings you to Rate Watch. And then you can start playing around with all the stuff here. That's how I learned. I just started playing around with it. So with that, that's kind of it for the most part. I want to say thank you guys for joining, and I'll answer the questions here that people have asked. So I already answered the one: average your clients are earning interest. I would say give them an average of somewhere between 6 to 8%. You shouldn't have an issue from that standpoint. How much of a portfolio should be allocated to annuities? That's a great question. It depends on the age. So there's going to be some question marks. So if you're younger, I'd probably say maybe less, but you also have to be savvy in investing, or you're going to pay someone to invest for you. So if they're like, you know what, I'd rather have the limited upside with no downside, and that's fine too, but I would leave that up to the client. So as you get older, like say, 50s plus, you should have probably about a 50-50 aggressive. And then as you get closer to 60, 65, it should be less and less aggressive. So hopefully that helps, which is funny because you work for Merrill, so you should probably know this. Just busting your stones. Yes, you can have a copy of this presentation. There's two ways you can do that. The first way is I'm going to put it in the chat. You could email me at phil@valorfs.com. Okay, that's the easy way. The hard way is emailing my other one, management@valorfinancialspecialist.com. So that's a longer email, but I'm trying to move over to this phil@valorfs.com to make it easier for everybody, present company included, when I tell people. And for you, my dear, I will gladly send it to you. The recording will be up on the YouTube channel. So as of tomorrow, it will be up. So once again, if you missed it in the beginning, the YouTube channel for Valor Financial Specialist is the tag is @Valor Financial. So I would highly recommend to subscribe to the channel. And then from there, you'll get a notification anytime the video is uploaded so you can watch it at that point. So from that standpoint, yes, it will be uploaded on the tube as well. Can you tell us more about the inherited IRA rider? Does it mean that someone that inherits money with this rider is not held the 10-year stretch? No, I'd have to pull up the Equitrust documentation. It's been a long time, like literally after I went independent and I had no idea what I was doing. And I'm like, help me. It came across the Equitrust product that can do that, but it's very limited in regards to how many people would fall into that category. Who knows? It might be more as we talk about this gray wave that's coming. So if you want to email me who you are, because I know you're anonymous here, just phil@valorfs.com and I can get you that information. So we can go from there. Uh, is annuity with bonus good or without? Even though it is free money, how much role it plays in the growth withdrawals? That's also a great question. So when you talk about bonuses, certain bonuses with carriers do play a role in the pars and cap rates. So when you looked at that, like a theme grid, for example's sake, showed, different par and cap rates. Theme is not as, visual with it as say American Equity. So American Equity has the Asset Shield 10. They also have the Asset Shield 10 plus bonus, which is a 10% bonus free, but the pars of the cap rates are much lower than if you did the one without the bonus. And so you'll find that people do that to move surrender charges. So if you're overcoming surrender charge, you need that 10% bonus to get you above the hump. That's typically what they're designed for. But I would look at the pars and the cap rates before I would look at the production of the product or the illustration and what it does. My illustration for my annuity, which I did a theme, was I put 200,000 in, and by 65, I'll have 1.5 million. Now, if I have 800,000 with that, and I had 4 times the growth, I'd be happy with that too. So the thing is that you have to understand from a consumer standpoint, comfortability. The illustration is not gospel, because the minute you start selling by the illustration, you've already lost. Because year two, they're not going to see the returns you showed them. By year five, it'll probably be very close, but you have to kind of eat crow every time you talk to them for an annual review. So illustrations, once again, prove that ink sticks to paper. That's it. When it comes to bonuses and the withdrawals, depending on if you're doing an income annuity, it doesn't matter. There's even a fee of usually like 1% or 1.10, some are 1.25, but it doesn't matter because all you care about is the funny money, as I say, or the monopoly money. That income benefit and the guaranteed income will hold tried and true. The 0% guaranteed column will still show guaranteed income. That's all that really matters to the client. So you should not have a worry about that. So all of this is situational. I haven't sold the same product or the same design to every single person because every person is different in their journey. And that's why I say the beauty of what we do is we fix problems that people don't know they have. And so they could be similar, but in 17, 18 years of doing this, not one client has been the same. So I encourage you to, last thing I'll say, because I'm not seeing any questions, I encourage you to find uh, 4 clients that you could talk to about this. We could do it together through joint field work. I can definitely help with that. But if you have not signed up for this yet, please sign up today. The rates on the rooms are going up after tomorrow. And frankly, if you even live local, some of you live off a different standard of timing. You know who I'm talking about. So if you even live local, it might be good to get a room and get it sooner than later because we're going to start at 8 a.m. sharp, and there's just a lot of information that's going to be done that day. And I'd hate for you guys to miss it. So May 11th, it's a Saturday, and it's free. So the only thing you have to pay for is room and board and to get there. But it'll increase your practice if implemented by 25 to 50%, and I can guarantee that. So with that, I see no more questions. I want to say thank you guys for the opportunity to speak to you today. Look forward to next week, and have a great rest of the day and a good weekend. So long.